All right, everyone, welcome back. We're diving into a question that's on a lot of minds these days, especially those just starting out with investing.
Definitely. It's a popular one, and for good reason, too.
So, get this. We got a listener who's ready to jump into the investing world, in India specifically. They've managed to save a good chunk of change, like 4.5 lakh rupees. Not bad
Ah,
from
that's a fantastic starting point. Shows some great saving discipline already.
exactly. But, they're a bit unsure where to put it all. They're looking at the Nifty 50 and thinking, should I just throw it all in there and let it ride?
I can see why the Nifty 50 would be tempting, especially for someone starting out.
Right. It seems like it's everywhere you turn. So let's break it down, for our listeners too. What exactly is the Nifty 50 and why is it so alluring for beginners?
Well, think of it this way. It's like the A-team of the Indian stock market. The top 50 companies, the heavy hitters, all in one place.
Ooh, I like that analogy. Makes it sound powerful.
It is. And for a beginner, it's appealing because it offers instant diversification, You're not betting on just one company. You're spreading your risk across 50 major players from all sorts of sectors.
So you're basically getting a slice of the entire Indian economy all bundled up neatly.
Exactly. It's a great way to get started and get a feel for how the market moves without getting too bogged down in picking individual stocks.
Makes sense. But, there's always a but, right? I've heard some chatter that the Nifty 50 might be a little overvalued at the moment. Is that something our listeners should be worried about?
It's definitely a valid concern. Valuations go up and down. That's just the nature of the market. No one can predict the perfect time to buy in.
So what do? Just cross your fingers and hope for the best.
Not quite. This is where a little strategy comes in. Have you heard of rupee cost averaging?
It rings a bell, but refresh my memory.
Basically, instead of plunking down that whole 4.5 lakh in one go, what if you spread it out over time?
Like break it up into smaller chunks.
Exactly. That's the idea behind systematic investment plans, or SIPs.
Okay, SIPs. Now, those I've definitely heard of.
With SIPs, you invest a fixed amount regularly, say, every month. When the market dips, you're buying more units at a lower price. When it goes up, you buy fewer units but at a higher price. It all evens out in the long run.
So it's like a built-in buffer against those market swings.
Exactly. It takes some of the emotion out of investing. You're not panicking when the market takes a dip because you're actually buying more at a discount.
I like that. It makes this whole overvalued thing feel a little less daunting. But our listener mentioned wanting to diversify beyond just the Nifty 50 eventually. So let's talk about that. If they're starting with 4.5 lakh rupees, how would you suggest they spread that out across different investment options?
All right, let's map out a plan. I'd say a good chunk, maybe around 50–60% of that 4.5 lakh, could still go into index funds. But here's a little twist. They could explore not just the Nifty 50, but also the Nifty Next 50.
Ooh, the Nifty Next 50. What's that all about?
It's like the Nifty 50's younger, maybe a bit more ambitious sibling. It tracks the next 50 companies in line, those with high growth potential.
So it's a way to tap into emerging trends and future stars.
Precisely. Now, for another layer of stability, about 20–30% could be allocated to large cap mutual funds. Think of them as those reliable, steady growth companies that have been around the block.
Solid foundation, right?
Absolutely. They help balance out the portfolio. Now, are you ready to add some spice?
Always up for some spice. What do you have in mind?
Hybrid funds. A good 10–20% could go there. They're a blend of stocks and bonds, offering a mix of growth potential with a safety net.
So it's like the best of both worlds.
You got it. And to round things off, let's not forget about debt funds. A small portion, about 10%, can act as a cushion against market volatility. Think of it as your financial shock absorber.
All right, this is starting to look like a well-rounded portfolio. Now, as our listener gains more experience, what are some other avenues they could explore? You mentioned FlexiCap funds earlier. Those sound intriguing.
They are. FlexiCap funds give the fund manager more freedom. They can shift between large cap, mid cap, and small cap stocks based on market conditions. It's like having a seasoned captain steering the ship, navigating those choppy waters.
So it's all about adapting to the ever-changing market.
Exactly. But even with all these investments, sometimes the best move is to hold some cash back.
You're talking about those rainy day funds, right?
Yes. Having a portion of your money in liquid funds is crucial. Think of them as your financial emergency fund, easily accessible if you need cash quickly. They're low risk and offer decent returns.
So it's like having a safety net while you're scaling those investment heights. Now, let's talk platforms. Where should our listener go to actually start investing?
Well, I'm a big advocate for direct mutual fund platforms. They cut out the middleman, meaning lower fees and more returns for you.
Can you give us some names?
Sure. Grow, Zeroda Coin, and ET Money are all great options. User-friendly, transparent, and cost-effective. Hard to go wrong with those.
Okay, perfect. We'll make sure to include those in the show notes too. Now, any parting words of wisdom for our eager investor?
Remember, investing is a long game. Be patient, stay informed, and don't panic when the market takes a dip. Those dips are actually buying opportunities in disguise.
Love that. So, to sum it all up, the Nifty 50 is a solid starting point, but diversification, SIPs, and a long-term mindset are your secret weapons to building wealth.
Couldn't have said it better myself.
And to our listener, remember, this is your journey. Align your investment choices with your risk appetite and goals, and you'll be well on your way to financial success. Happy investing.